Hello and welcome back to another episode of DeFi Decoded. I am Alex Tapscott here with Andrew Young. Andrew, we've had some good guests in the last couple weeks, which has been enlightening and illuminating, but it has prevented us from talking about the nitty-gritty of what is going on in the market. And quite a few weeks it has been. I think it was 2 Fridays ago or 3 Fridays ago now at this point, we had the flash crash, which saw, I think, the largest liquidation in the history of crypto. I'm going to want your insider scoop on that event. One of the things that had me kind of interested in that event was the fact that a lot of the wealth creation that's happened in this market has happened in the public markets. So when something happens after the close, which is something that didn't used to exist in crypto, but now it does because of the interaction with the public markets, on low liquidity, you can have this sort of cascading effect. And there aren't the same kinds of buyers you typically see sort of waiting in the wings, because a lot of the new buyers are actually in the public markets and are not like waiting around on an afternoon. So that was sort of my take, but I know there's some other sort of more complex ways of approaching that. But things have really recovered since then. I mean, we're not back to all-time highs, but Solana's over $200, ETH's over $4,000, Bitcoin I think is like 114, 115K. So things are looking good. It seems as if most of that, though, is not being driven by things that are native to crypto, but rather the whole market as a whole. Like the S&P, as we record this, it's October 28th. The S&P 500 and NASDAQ 100 are at all-time highs. Most of the Mag 7s are at all-time highs, which is driving the broader market. Gold has had a pretty sharp sell-off, so it seems like risk is back on, and that generally is dragging up the rest of the market. So why don't we just start with a quick post-mortem on the flash crash. It's been a couple weeks, which in crypto is like 10 years, but it still seems to have a little bit of an overhang over the market, so I think it's worth addressing right off the top.
Yeah, for sure. It was pretty crazy. It's being considered, crypto's Black Friday. Essentially what happened was President Trump tweeted out that he was putting 100% tariffs on Chinese imports. We got kind of a very sharp, sell-off in equity markets, crypto markets, kind of everything across the board. Everything went risk off. But the drop in crypto was particularly brutal. And the reason why was you had what's called a liquidation cascade, where effectively anyone who is leveraged long, once the price started dropping below a certain point, they got force liquidated, right? So perp exchanges essentially allow traders to put on leverage and to make sure that the exchange doesn't blow up and that they get their money back. They effectively force sell people if their position goes too low. So people were essentially just extremely long for the most part. And so this triggered like a cascade of people getting deleveraged, which essentially means they were getting force liquidated, which then drove the price even further down, and then led to even more liquidations, and it was pretty crazy. Like we essentially saw like a flash crash in crypto. It was particularly bad for altcoins. So, and this was also across every venue. So it wasn't even just like a couple smaller exchanges that this happened. This happened across the entire ecosystem. Some coins were actually trading at like near zero, like literally like 99% corrections in an hour. I think at one point Atom, Cosmos, which is it's a good project with like actual fundamentals behind it. It was trading at like 10 cents for like a brief moment on Binance, and just like the current price of Cosmos right now is like $3.20. So, and prior to the crash, it was $4. So just to give you a context of like how crazy this was.
Yeah.
And so essentially what happened is literally anyone that had leverage on got force liquidated and lost their whole position. And it even, just the way that these exchanges work, they like just based on how they do their risk management, even people who are long short, their long position would get liquidated, and then their short position would actually also get liquidated at the same time, essentially force liquidated at a profit. But
why is that?
To be honest with you, I'm not a perp dex expert, but my understanding is they essentially, to like make sure that the whole system is solvent, because perp trading is zero sum. If prices are going to zero, then the short sides, are essentially making a huge amount of money. And so to keep the system solvent, when the exchanges force liquidating the longs, they actually have to also force liquidate the shorts. So they don't actually make as much money as they would normally, just because like the whole system is essentially de-risking across the board. And so so it blew out a lot of long-short traders because their long positions went to zero and their short positions didn't actually fully compensate for the loss. Yeah, it was really just a deleveraging across the board.
So was it a flash crash in the pan, or is this something that has had a lasting impact on markets? Where are things now?
Yeah, honestly, it's had a pretty lasting impact, I would say. So much leverage has been taken out of the system. Bitcoin and Ethereum both mostly recovered, but like the altcoin sector was already in a very rough shape, and this has just completely wiped out even more of the speculative capital behind these things. And so a lot of the altcoins have not recovered. Like Atom is a good example. It was $4 before. It was already at like a depressed price of like $4. Flash crash happens, and now it's only recovered to 3. So it's still down 25%, based on essentially just like a factor that's completely outside of Atom, Cosmos' control, Atom's control. Like it's essentially, you know what I mean? So for the most part,
Atom is not alone. I mean, like even ETH is $4,100. I think it was like closer to 4,500 before the crash. So it's bounced back quite a bit. Less than 10% from where it was, but still not fully recovered. Same with Bitcoin too. So, yeah, I mean, after the crash of '87, it took a year, I think, for the market to get back to where it was. Even though a lot of people might say that there was no specific fundamental reason for that correction. So these kinds of corrections can have a lasting effect on the market for sure.
Yeah, one thing to keep in mind too is it did expose how thin liquidity actually is.
Well, this is going back to my point. Like, so do you think there's any credence to my theory, which is basically like, so in previous bull cycles or cycles, people do make money on Bitcoin, and the wealth effect from that causes them to recycle that capital into lower cap, tokens, because that's what happens. And it happens in every market. This used to happen back in my days in the mining market and oil and gas. It's like everyone's looking for like the new thing that's going to give them extra leverage, whatever it may be. And so that's been a big sort of tailwind for a lot of small cap and mid cap crypto assets. This time around, it seems like there was a wealth effect in Bitcoin, and IBIT being the big beneficiary of that. That's the BlackRock ETF. But a lot of the capital has flowed into digital asset treasury companies, some operating businesses. Like the IPOs this year have been absolutely gangbusters, at least initially. The track record over the long term, a little more uneven, but there seems to be like a wealth effect in Bitcoin and people rotating into public market stuff. So my point is like, if you have a flash crash in the underlying market, the crypto market, there isn't necessarily like a bunch of bids like in the order book for people who have like made some money and are waiting to like scoop something up at a better price. It's like almost like that part of the market has been hollowed out somewhat, and that's what led to these cascading liquidations that caused stuff to go to like a nominal value of zero, at least temporarily. But I don't know. I think what you're saying corroborates it, but I haven't seen like no one's done the full data dive on this thesis. It's just my read of what's going on.
Yeah, I mean it's the revenge of the boomer TradFi system. It's sucked up all of the speculative capital in this market cycle. It's all gone to it's gone to public equities effectively, crypto linked public equities, I should say.
Yeah.
So and yeah,
public equities, digital asset treasuries. Maybe not even AI, like speculative stocks, quantum, meme stocks. It's like it's in that universe. It's not in the other universe, right?
No, yeah, we've seen so many pump fakes in the last 2 years, where Bitcoin, Ethereum, not even Ethereum really, mostly just Bitcoin, has outperformed, and then people kind of finally think the rotation to altcoins is coming, and then boom, we get some sort of like flash crash or just like unwind of the trade before it even gets going. So the altcoin market is just like, I mean, I feel like we come on here every like 3-4 months and talk about how the altcoin market, maybe this is it. But at this point, it's like, stop beating a dead horse.
Yeah.
Like this thing is just, who knows?
I remember I wrote a newsletter like in June or July. I was like, are you ready for a long alt season? And we were looking at Bitcoin versus ETH ratio, which still looks better. That's still trending. But, Bitcoin versus alts. I mean, the fact is like, hate to say it, but I'm pretty sure Bitcoin started the year at like 105 grand, right? And now it's 110 grand or whatever. So it's barely moved at all. And for some of these other names, it's a lot more uneven. I think ETH is flat, Sol is flat, and most stuff is down. So it's a funny sort of thing to be talking about the bull market when, for all intents and purposes, we've been flat for almost an entire year, which, I don't know, like, whose bingo card would have been the NASDAQ up 20%, the S&P up whatever it is, 15%, gold up 40%, NVIDIA up 60%, and Bitcoin flat and ETH down or something like that. Like it seems as if it's somewhat out of step, I think, with the rest of the market.
Yeah, I think honestly the biggest issue, and I think where the sentiment is right now, is around two key things. One is the sort of like broken tokenomics, or like the broken economic models of a lot of these crypto assets. That's kind of like the first piece. And then the second piece is like market microstructure. Just like there's widespread, I guess, disgust, hate, I guess, versus centralized exchanges, centralized crypto exchanges, around this like mostly extortionate prices that they've extracted from projects.
Yeah.
So what I mean by that, so centralized exchanges right now, it's sort of rumored that the really big ones require somewhere between like 3 to like sometimes 10% of token supply to get listed on their venues. And those tokens typically go to either the exchange itself or to the customers of the exchange, which on one side is good, like you're able to build like a community of holders and therefore supporters, but in reality it just creates massive sell side pressure as soon as the project's token actually lists. And so and then it essentially means like a lot of these tokens have incredibly ugly charts once they actually release their token. It's kind of like how like the IPO market has that classic first day pop and then slow unwind. The crypto market is sort of facing the same type of chart template for new tokens, but I would say it's even worse than that. Like these aren't like 50, 60% declines. These are like 90, 95% declines within a year. So that aspect, the market microstructure aspect, is very negative and is a huge overhang. The second big aspect is around the economic alignment of these tokens. A lot of these projects are not fully decentralized yet, and their model, it means that there's like a fundamental misalignment of incentives between the project contributors and the actual holders of the tokens themselves. And because of that, people are discounting a lot of these crypto assets massively. And so tokens, funny enough, have really high cost of capital. You actually have a much higher cost of capital launching a token right now than you would have had in the past. And so that's like another interesting component. It's part of the reason why tokens that now generating revenue and having a product isn't enough. You need to actively be buying back your token to show alignment with your token holders. Like it's almost a market signaling mechanism at this point. And so that's why like projects like Hyperliquid, for example, have had their token price performance has been actually quite good. Also, you want to go off mute. You go on mute when you're talking. Sorry, when I'm talking. So it's very loud. Yeah, that's better. Oh, Jake will have to just cut out this a little bit. But yeah, it's super loud. Hopefully it's okay. But anyways, whatever. Cut.
Yeah. So, Andrew, I don't know if people caught that because of the sound over top of it.
Okay, I'll start again. We'll just cut this whole thing. Yeah. So what did I first talk about?
We were talking about exchanges taking extraction.
Okay, yeah.
Yeah.
So yeah, there's two reasons why I think the altcoin market has not really recovered. The first is the broken alignment between token holders and the projects themselves. So what I mean by that, we're now at the stage where crypto projects, most of them have a usable and valuable product. A lot of them now generate revenue, but there is not a clear linkage between the token and the actual technology itself. And because of that, the cost of capital for token founders is actually incredibly high, because people, unlike a company where there's clear legal agreements, dictating the sort of alignment of incentives between like the project and the holders, the equity holders, there is no such sort of contract with these tokens, and so people are discounting tokens, even if they have great fundamentals, because they just don't feel like they're going to be treated essentially fairly by the founders or the team, and it's one of the main reasons why projects that actively buy back their tokens are the only real tokens that have done well, because it's almost like even more than the actual act of buying back the token, driving up price. It's the market signaling aspect of returning value to token holders that allows people to feel like those types of projects are actually investable. So essentially what's happened is like the scope, the appetite for the market to fund sort of long tail venture style bets in crypto has completely collapsed. At this point, the only tokens that are really trading well have a product that's being used, generate revenue, and actively use all of the revenue to buy back the token. So that's kind of the first piece. So the second aspect too is essentially there's huge issues with market microstructure. So effectively, the way these tokens actually trade is a huge drag on performance. So right now, most centralized exchanges, for example, where most token trading happens is on centralized exchanges. And for projects to actually get listed on the big centralized exchanges, it's sort of rumored that they have to give up to between 5 and 10% of their token supply to the exchange itself just to get listed, which is incredibly high if you look at what traditional companies pay to get listed on the New York Stock Exchange or things like that. Like, they don't need to give away 5 to 10% of their cap table to the exchange itself. And so it's a relatively broken market microstructure aspect where exchanges, they do some curation to a certain extent, but they're almost overly profit driven, and it's very much like a pay for play type situation. And so a lot of projects don't have the liquidity that they deserve, and other projects have a lot more liquidity than they do deserve. And the net result also is that if you do want liquidity, at least on day one of your token launch, you need to give up huge economics, and that economics typically goes to either the exchange itself or essentially users on the exchange who really, for the most part, don't have much buy-in on the project, and so they're essentially just dumping these tokens on day one. And so it leads to the situation where a lot of the new token charts resemble sort of the classic IPO chart where there's a pop on day one and then a slow decline. But I wouldn't say these are slow declines. These are like 90% plus declines within a couple months. And so Yeah, so essentially those are like the two biggest reasons why the crypto altcoin market has not been able to recover.
Two very well articulated and I would say quite compelling reasons why most of these names will never really recover, right? And it's something actually that sounds pretty gloomy, but I think is quite logical. Arthur Hayes, who's someone we talk about on this show quite a bit, posted something on Twitter today where he said he was just reposting something from the main market, which is that 3% of stocks have contributed like almost all the gains to the S&P 500 and the Dow Jones, and that has been true for like a century. You know, people talk about the Mag 7 stocks and how if you strip them out, actually, you know, the market's doing pretty mediocre. And it's like, well, actually, going back since the dawn of the stock market, the modern stock market, you know, from the 20th century onwards, this has been true. And so, you know, most of your alts are not going to do well. It's just the reality. And it's arguably even more obvious, or should be more obvious, within crypto, because public companies are way more mature, relatively speaking, than most crypto assets are. You know, in terms of having, you know, like they found product market fit. They have customers, they generate revenues, you know. Not all of them are well-run businesses. Lots of them go under, some of them merge, some of them get taken over, whatever. But like, they are actually more mature than most crypto projects. Crypto projects are more akin to venture capital, and the success and failure rate in venture capital and the power law within venture capital applies even more than it does in public markets. Though, interestingly, if that data is true, they start to look quite similar, you know, because they say like 10% of your VC bets lead to 100% or most of your performance. And it seems like that's true and even more true in the public markets too. So I'm with you on all this. I think it's more people needing to accept that a bull market, such as it is, does not mean a bull market for every single asset. Not every single name will go up in equal measure or at all. And when we talk about bull markets and stocks, what are the things that we're looking at? We're looking at indices like the Dow Jones index or the S&P 500 index or the NASDAQ 100 index. These are curated baskets of mature operating companies. And they're not even market cap weighted. There's plenty of companies that by market value are way bigger than many of the members of the S&P 500, for example, but are not included for whatever reason. I mean, it's sort of like secretly the biggest actively managed fund in the world is these indices because of the amount of ETFs and strategies that are associated or attached or benchmarked against them. So where was I going with this? Yeah, so like actually what we probably need is like a crypto 50, like an actual index. I mean, I've developed something that's quite sort of similar to this. It's like the Mag 7, but the next generation of big protocols are not going to be, or big winners are not going to be public operating businesses. They're going to be protocols, but there's not going to be thousands of them. To your point, there's probably going to be a much smaller group that have found that product market fit, are really dominating key industry verticals of the digital asset-enabled internet. And so we don't call them the Mag 7, we call them the DAG 7, the digital asset group of 7. You know, so like Bitcoin, DAG 7. Like could Bitcoin be a $10 trillion asset? 100%, right? Like it is the only thing that kind of comps to any of the Mag 7 in terms of size. But ETH is pretty big. And I think Ethereum, if stable coins and RWAs and distributed applications and all of this innovation keeps happening, they're going to be a big beneficiary. Solana, I think, is probably broken on through to the other side, right? It's internet capital markets. It's getting ETFs today. Lots of sort of momentum there. And then, you know, there's some interesting platforms out there. You mentioned Hyperliquid. There's Avalanche. We've talked to some really great people from the Avalanche community on this show over the years. There's, Binance Chain, BNB. You want to talk about platform economics. To your point, I mean, if a lot of projects are launching on exchanges and they're paying sort of a fee to do that, then the more projects there are, the bigger a platform like that becomes. But we're now up to like what, 5 or 6 different names, you know? Athena, that one's sort of interesting. I think we need like a DeFi native stablecoin that isn't like strictly, like centralized. So we've had some attempts at that didn't always work out. But anyway, my point is only like there aren't thousands of use cases for crypto yet, right? And there aren't thousands of protocols that are going to become massively valuable, I don't think. So I do think you're going to have this situation where you have a group of winners that does really well. And if we had an index for those guys and we track that index over a 5 or 10 or 20 year period, then you may see that actually we are in a bull market. It's just that everybody else's stuff isn't doing so hot, right? And I just think, like, if you look at the Russell 3000 or some of these other measures of other equities, you'll find that they don't come close to performing as well as the large cap stocks have done over the past little while. So anyway, I digress. But that's what I'm saying on this, which is like how I learned to stop worrying and embrace this market in a way. It's like you're not going to just see everything go up at once. And so if that's what you're hoping for, like, you can't rely on that. Hope is not a strategy. Let's talk about something else.
No, just really quick. I mean, I think like one of the charts, for example, for me that was very interesting to see was if you actually look at the TSX Venture Index over a very long time period, it's like massively down.
Or it's down, yeah.
It's actually down like 60%, just like since October 2006. I mean, there's a lot of reasons why, but that's like that to me was interesting. I didn't like I guess I grew up in the world that there's a small cap risk premium, and you actually get paid for taking that small cap risk premium, whereas like the data does not really bear that out.
No.
I think just on the side, like the two issues, I actually think there's solutions coming down the pathway for both. So on the liquidity side, like the market microstructure, I think there's some really interesting things happening. So one is a lot of new projects just launched fully on chain, which is fully permissionless, and the amount of like on-chain trading volume as a percentage of total crypto trading volume continues to go up. Hyperliquid, for example, for leverage trading is now, I think it's like almost a third of total leverage trading, and it's similar sort of story for spot trading. So I think like on-chain trading, that sort of solves a lot of the issues. And then on the other side, it seems more and more likely that we're going to get potentially spot crypto trading on traditional venues. So that may solve liquidity in a sort of different way for like the really top assets. We see every day more TradFi institutions allowing more types of integrations with crypto assets. I think I saw something that like crypto can now be used as collateral for JP Morgan accounts or something. Yeah. So I think those two things are both really good. And then on the economic alignment side, I think there's a lot of really interesting things happening. There's two really interesting things happening. One is the Genius Act is sort of specifying what kind of assets are going to be considered decentralized and therefore have sort of less regulation and less oversight versus other assets that aren't decentralized. I think that's going to create a huge economic incentive to fully decentralize projects because, and once you fully decentralize a project, the token effectively has ownership over the protocol because there's no, like, the team still contributes to the protocol, but the protocol itself is not owned by anyone. And when it hit just sort of like escape velocity on decentralization. So that, to me, decentralization is like the best way to solve that economic alignment problem, and the Genius Act is going to incentivize that. So I think there's solutions coming down the pipeline on both the technical and legal side. So I'm very bullish. It's just where we are today, is not, there's still a lot of issues, and a lot of those issues have been sort of bubbling up, and it's kind of like why the cost of capital for crypto projects is so high at the moment.
Yeah. So in the time we've got, I want to talk a little bit about something that's going on in the digital asset treasury market. So when we first started talking about this market back in July, there was a really compelling trade that was going on where these digital asset treasury companies would launch priced at NAV or sometimes even at a modest discount to NAV. And people would subscribe in these PIPE offerings, these private investments into public equities. And then they would watch as the shares re-rated in value and hopefully would remain that way, trading at a premium to NAV. And the thinking was that if you looked at MicroStrategy and some of the other more established players, they traded anywhere between 1.5 and 2.5 times NAV, so others should follow suit. And in a way, this was a really kind of an amazing thing that happened. And I don't think it's over, but it was at its zenith in the middle of the summertime. And as a result, we saw tens of billions of dollars of capital formation around these mostly single asset, digital asset treasury companies. But in a way, they've become a bit of a victim of their own success. And as a result, the average MNAV for, say, Bitcoin DATs has gone from like 1.6 times to closer to 1.1 times. And a lot of that is actually MicroStrategy. If you take MicroStrategy out, the remaining Bitcoin vehicles actually trade below NAV. And that's true in general for the majority of the space. So when we first started talking in July, I think it was like 80% of DATs traded above NAV. I think today it's less than 40%. So more than half now trade below. And one of the reasons for that is that though there's lots of buyers for a relative value arbitrage trade that can happen over the period of a few weeks or months, there are fewer obvious long-term buyers for digital asset treasury companies. And one of the reasons for that is because people know the difference between Bitcoin and ETH. And though Coinbase and Gemini and Galaxy and these companies operate in the crypto space, they're still businesses that people can wrap their head around. Investors can understand who's making money, who's not, who's growing, who's not. But when it comes to most of the crypto asset complex, they don't really know the difference between like Bitcoin and ETH, let alone ETH, Solana, Hyperliquid, or Avalanche, or some of those other names that we were talking about. Like, we know about it, we talk about it. I think our listenership certainly knows about it, but the broader investor base maybe does not. And so now we have this situation where there are some vehicles trading at a discount to NAV. And when you're a single asset vehicle and you're trading at a discount to NAV, the thing that you relied on for your growth becomes a lot more challenged. Typically, what you want to do is use your stock, so issue shares at a premium to NAV in order to buy the underlying asset. So it's like you're selling stock at $1.10 to buy $1 worth of Bitcoin. So over the long run, that's going to grow the amount of Bitcoin you have per share. So they call that the Bitcoin yield. A bit of a misnomer, but the idea is this is the amount of new Bitcoin, your Bitcoin growth per share that you see over a period of time. It's not yield in terms of interest, but rather growth of the Bitcoin stack. But what happens when you trade at a discount? You can no longer do this trade. And something else happens, which is that actually it becomes more sensible for you to actually sell the asset to buy back the stock. Because basically, if the stock represents a claim on the asset and it's trading for 80 cents, you can sell $1 of the asset to buy the same asset, if you like, in terms of shares, at a discount. And in the long run, that will actually have the effect of closing the NAV discount with closing the NAV discount so that you end up closer to NAV. So this is something that we now have seen play out in a couple of interesting ways. So one was this company, Semler Scientific, bought another DAT, paying a premium to its NAV, but because the relative value was higher, it still was accretive. But then more recently, yesterday I think it was, we saw this company ETHZilla, sell ETH to buy its own shares and was rewarded by the market. The market liked this move. So Andrew, I think I did a pretty good job of explaining how all this works, but you tell me what your thoughts are. Are more of these companies going to do this? If the market rewards you for doing something, it usually leads others to do it too, right? Because they see that's the way to improve their share price. Let me know what you think.
Yeah, I mean, this is the effective, this is the TradFi DAT equivalent of a potential liquidation cascade, is kind of how I think about it. But we're not there yet, because in a world where all of these things trade below MNAV and all these DATs start unwinding their trades, unwinding their sort of spot holdings, then that's when you start to see, the spot price can start to go down a lot, use that capital to buy back the shares, and then you get this flywheel situation where lower spot prices lead to lower MNAV multiples, which lead to more selling and therefore lower spot prices. I think we're not there though, to be honest with you. So I think this is one of those situations where the market is still pretty healthy for the major crypto assets like Bitcoin and Ethereum. And so I would say like right now, the sort of DAT market this is like the first trial balloon for this type of strategy. And in a bullish market, this is accretive, and whoever does it, the market should reward. I think in a situation where every DAT company is doing this is a very, very different situation. But we're not there yet in terms of market cycle. And so I think for now, it's just an accretive thing to do. I think the other thing you could do too is like, if one company was trading at a higher multiple than another, it becomes accretive for the company to also just acquire the other DAT. And I think we'll see that with some of the smaller crypto coins, smaller crypto DATs as well, just because there may be some liquidity issues. But yeah, for now, I just think it's like a accretive thing to do.
I'm with you. So here's another thought, which is if you're a Bitcoin or an ETH DAT, selling the underlying asset, like 50 million bucks of ETH or whatever, ETH's flat, maybe even up a little since that news broke. It's not moving the needle, right? It's a $500 billion asset. Bitcoin's even bigger. So unless MicroStrategy starts aggressively dumping Bitcoin, no Bitcoin DAT activity, I think, is going to mess with the Bitcoin price too much. I may live to eat those words, but that's my point of view. However, when it comes to smaller assets, especially where the DAT itself is foundation backed, right? So a foundation seeds the DAT with a bunch of its own tokens at a huge discount, with the understanding, or like with the hope at least, that the DAT is going to act as an ongoing buyer of the token. And if that DAT decides that then is going to sell the token in order to do this value arb, that kind of runs completely counter to the entire purpose and founding principle of this strategy, right? It's like it goes completely against it. And not only that, if the asset's a 5 billion market cap, single asset that it has one DAT, and that DAT sells $50 million worth of that token, you better believe that's going to have a huge impact on the price, which in turn drags the value down of the assets inside of that DAT, thus making the entire thing counterproductive, right? So my point is only, don't expect every DAT in the world to start buying back its own stock just because this worked one time for ETHzilla. I think for Bitcoin and ETH DATs, you are going to see some of this selectively. But anytime where there's a foundation or a major principle of the project that's behind it, there's no chance they're going to do that, I think, because it seems like a complete reversal of its principle of why it exists, but also may prove to be self-defeating for the reason I described, which is that it might crash the token value, thus killing the NAV of the DAT itself. So again, and yet another reason why I think certain single asset DATs are really going to be quite limited in what they can do if they end up trading below NAV. And that I actually think creates some interesting opportunities for investors and consolidators, as you've described it, which I would love to tackle that topic much more in another episode, because it's something that we're very interested in here at CMCC. But it's kind of obvious that this is what's happening in the market, and that there needs to be some consolidation and new investors, new kinds of investors coming into this market, because the current trade is in a bit of a stasis at the moment. And I think that this is as good evidence as you're going to get of that. So I don't know if there's anything else to add. We were chatting for a while here, Andrew. That was a nice little debrief on what's what in the market. It's funny, there's enough going on that we didn't even mention the fact that Solana, HBAR, Litecoin all got ETFs today in the US. Ho-hum, yeah, kind of. Someone was saying, the boys, James Seyfarth, who's been a guest on the show, and Eric Balchunas, his colleague, were saying because the government is shut down, everyone assumed nothing was going to get done. But actually it's with the government shut down, there's nobody to say no, so you can just do things and launch ETFs, which is crazy. That seems to be what has happened here. It's in the absence of a no, it was a yes, and now they're launched, which is not true for some of the operating businesses. We know that there's certain companies that have filed to go public, whose prospectuses are still queued up with the SEC because of the government shutdown. So that's not something that's widely applicable. But yeah, anyway, there's just a ton of stuff going on. So we'll try to be a bit more brief on each subject next time, because I feel like we we went deep on a lot of things, but lots more to discuss. It's going to be a really, really interesting fall. And I can't help but say please go back and listen to back episodes of this podcast if you're just finding this podcast for the first time. Like, you want to hear from like Matt Hogan or Hunter Horsley from Bitwise, when they were talking about all this stuff. Now it's all happening. Luigi and John Woo from Avalanche. Now Avalanche just got a DAT in the market. Things are going great. We've had founders and key people from like every single corner of the crypto industry. I'm not trying to toot our horn, but I just think like we have an immensely valuable back catalog of content that people should be going and listening to. Because honestly, even if it's a few months old, it's just brimming with alpha and I think some really interesting insights. So that's it for this week's episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. Thanks for joining us, and we will see you next time. Take care.